Welcome back, guys. Today we're going to take a look at Lockheed Martin. Now, Lockheed Martin is basically a government arm. They make weapons for the U.S. government. I'm pretty sure like 98% of their contracts are for the U.S. government. So this company definitely isn't going away anytime soon. At least as long as the U.S. military continues to spend, then this company is going to be around. And the all-time chart shows that it's basically just up and to the right. These are charts that I like to see. Very nice. Now, in the past 5 years, we are up 38% on Lockheed Martin. That has underperformed the S&P 500. And as a general rule, I'm not usually a huge fan of aerospace companies because they just have a lot of like plants and equipment and stuff, and they're competitive with other aerospace industries. However, Lockheed Martin being locked in with the U.S. government, there's not a ton of competition there. But yeah, let's take a closer look at the financials here. $111 billion market cap. This is like the largest, I think, largest aerospace company, and price to earnings ratio of 17. That's not bad at all either. Taking a look at the revenue. The revenue growth has been okay. It hasn't been like stellar or anything, especially not in the past 4 or 5 years. But from 2017 to 2023, I mean, that's what, like 4% a year probably, from 50 billion up to 67. That's not too bad. Probably like 4% a year. Probably keeping up with inflation or a little bit more than inflation. And then it translates like pretty much at a 10% margin, like most times. It seems like just with the deals they make with the government, they always make sure to have a margin. In terms of their balance sheet, they do have some debt. They have 16 billion in debt, so we'll have to take that into account. And their book value has been decreasing every quarter for the past 6 quarters, so that's not a good sign on their book value. In terms of cash flow, what are they doing with their cash? Well, they actually buy back lots of stock. They buy back tons and tons of stock. They also pay a dividend, and they actually took out debt in 2022 to buy back stock. Once again, I'm not really a big fan of that type of stuff where they take out debt and then they buy back stock with it. That's kind of annoys me. In terms of their stats, their return on invested capital is really high. That's actually, I did not expect that. That's really nice. And their gross margin around 15% translates to a net margin of around 8 to 10% usually. So they make most of their money from aeronautics, from building aircraft. And then they got missiles and fire control, rotary mission systems. They actually made some money off space, which is really interesting to me. Those are their net sales, and then their profits. Almost all of these segments translate to 10% profit margin in operating profit. And then in terms of their so they actually have lots of orders for their different weapons. And yeah, this is their backlog, 57 billion in backlog for aeronautics. So they've got plenty of orders to fill. Now, I'm not quite sure what these deliveries are. Like, what the heck does 5 mean? Does that mean 5,000? Or 5? There's no way that's 5 million, but it could be maybe 5,000 or 3,000. But there's no way they just made 3, right? No way. Anyway, the analysts are thinking that they're going to grow by like 10%, well, 7% into 2025 in their earnings per share, and then 3% in their revenue. Very steady revenue growth is what the analysts are thinking. I tend to agree with the analysts on this. They'll probably have slow growth moving forward. In terms of their stats, they have a very low short percentage. That's a total green flag. Very low. That's nice. To the spreadsheet, here we go. We've got the earnings estimate. I put the revenue estimate here. Buybacks, 5 billion. Net debt of 16 billion. Discount rate of 10% because I want a 10% return on all of my stocks, and an exit multiple of 17. That's currently what they're trading at. I feel like that's fair for this business. That's a slow grower, but it's very safe for the most part. And for the discounted earnings model, I have them growing it by 5% and then 3% thereafter, coming out to a fair share price of 398, but when you account for debt, it's about 330. So I'd probably put their share price around like 360 probably, like split the difference on these two, probably around 360 would be the fair share price. At least if you want the 10% return moving forward. And with the revenue margins model, almost the same thing. Growth of 3%, that's kind of what the analysts are thinking, 3 or 4%. And profit margin of 8% this year, and then growing back up to 9%. They've had years where they've been at 10%, but they've also had years where they're at 8%. So I think 9% is a fair profit margin for these guys. And in this case, the fair share price is 405, and after debts, it's 336. So I probably put their fair share price around like 370, 350 to 370 probably, or 360, 370. Yeah, currently they're trading way higher than that. I'd say if you bought them today, you'd be expecting maybe 7%. Yeah, I'd say if you bought them today, you'd be expecting a 7% return. So not bad. Like, this company is not going away. It won't be a terrible place to put your money. 7% return is still better than treasuries, so it's not horrible. But there are better ones out there. At least I think so. So yeah, that's what I think. Let me know what you guys think in the comments. And if you guys want to try the spreadsheet, make sure to check the link in the description. You can try the spreadsheet. All you got to do is fill in these yellow boxes. Otherwise, make sure to hit that like button, and I'll see you in the next video.